It's Terrific Tuesday, which means we're talking all things business. And more specifically, after 9 o'clock, we do Small Biz Matters with Lexi Boyd. Lexi, it is good to have you here.
Yes, it's going to be a great show today. Very jam-packed as it is whenever we have our guest fest, as I like to call it.
A guest fest.
A
I
guest
like
fest.
it. There you go. And our guest this morning is Ursula, who's going to be talking with us all about... well, I'll tell you what, we did a bit of a rundown earlier, but let's just jump straight into it.
Indeed. So welcome to the show, Ursula. Thanks for coming on.
Hi, Lexi. My pleasure. Thank you.
We're going to be talking a little bit today about the difference between being a sole trader and a PTY Ltd. I'm not even going to try and put these into words. You do this so much better than I do. But first, can you just tell us a little bit about your experience working with small businesses? You obviously have Legal Vision, which is a fantastic company which specialises in small to medium business legal matters. Did I get that right?
Yes.
Excellent. And can you tell us why this topic in particular is so important for business owners to get their head around?
I've been working with small businesses and working as a business lawyer for over 15 years. Why is it important for businesses to get their structure right? We like people to get things set up from the start so they can concentrate on what they're best at. That's one of the key things I try to do as a lawyer. If we have people set up right at the start, we give them more options. So, for example, if you know you just want to keep your company small, it's providing you with an income, you may just want to be a sole trader. That's minimum admin, minimum hassle. And that's what you want. More time to focus on your business, less admin hassle. On the other hand, say you plan to grow quite a lot, bring other people in, bring in investors, but potentially franchise. It makes sense to start with a company right from the start, because then the right entity owns your assets, starts employing people, you can bring other people in. You don't have to stop, say after a year or so when you're successful, and redo things. You've got the right platform right from the start.
It's so important, and it's a lot about what we talk about here on the show, is getting things right the first time you do them, whether that be your processes and procedures or whether it be when you're inducting your first staff member. And it's also about creating a bit of a level playing field for you and your staff. If you've got everything correctly set up in the first place, then everybody feels more comfortable working for you. Your clients feel more comfortable working with you. And I think that everybody has that confidence to know that, hey, this is something that's actually a real entity and it's not some sort of backyard garage job. I'm actually working with someone who knows what they're doing, not only with what they're doing, but with their back end as well.
Yes.
You've got to have that professional presence. I think it's very important.
Yes.
So, really, let's talk about the main differences, because it's a question I get asked a lot with my clients when they come to me for admin consultation. As you all know, I work for Boyd Office Management Services, proud supporters of Triple H.
Yes.
And what they do, they ask me a lot of the time, look, I'm a sole trader, here's what I'm earning, when do I think about becoming a PTY Ltd? And there's a lot of things to consider, but it's about the pros and cons. It's about looking at each of these items. So let's look at the main differences between a sole trader and a PTY Ltd. So first of all, the registration and the fees. There's always fees, but which of them has more?
Okay, between a sole trader and being a company, the sole trader generally has less fees. So as a sole trader, you are your business. You might choose to register a business name, which is a pretty nominal cost. But, and then you have your own personal tax costs each year. As a company, you have to register that company, and that costs about $500 through the Australian Securities Investment Commission. Plus you have annual costs through ASIC. Then you have your annual accounting and regular BAS costs. So you, as a person, have tax returns, etc. to do, and the company separately has accounting.
That's right. So you can't bundle them in together. You can't have the one cost which covers both of them, because you're two different entities now.
Correct,
you're a personal person
yes,
who is paid by your company. Perhaps
Yes.
you might be paid a wage. And then also you have the company company's paperwork to do as well.
Yes.
And just so I've got this straight, because this is something that I've been banding about a bit, if you're under ASIC because you're registered with ASIC, does that actually mean you are now registered on the stock exchange?
No, so most companies are private companies, and that's what PTY Limited means proprietary limited, which is a private company, not on the stock exchange. Companies can list on the stock exchange. then they become a public listed company, and that means you
that's
can
the
buy and
difference.
sell shares.
Gotcha.
Yeah. You can
Okay.
there's actually 3 types of company: private, public unlisted, and public listed.
Okay, and that's where that difference comes in with where you're listed on the stock exchange,
Yes.
to use a bandied expression.
Yeah.
So talk to me about liability. Liability is a big one that people consider when they want to become PTY Ltd.
Yes.
Sometimes I talk to people and they say, look, I'm worried that if I do something wrong with a particular client, a new client who I don't really know very well, they might take my house.
Yes.
So how does that work with liability?
Look, this is one of the main considerations for people. Should I be a sole trader or should I be a company? As a sole trader, you are personally responsible for all the work you do, and regardless of the quality of your work, you never quite know when you might be sued. So which genuinely means if you're sued, your personal assets are at risk. For example, your house, your car, etc.
Anything that's in your name,
Correct,
basically.
anything in your name. Yes.
Is that the same if you your house, for instance, is in both yours and your partner's names?
If things are in joint names, they're still at risk. If
Right.
they're in someone else's names, they're generally seen as separate.
Okay. Okay, because that's a big question you often get asked, because people say, I want to reduce my liability, and can I do that? I mean,
Yes.
that's a big question that probably be a good idea to get an insurance broker on the show, actually, to talk about
Yes.
all that liability and how you can split it and that sort of thing.
Yes. On the company side, it's not that you have no liability. So the main liability is just for the company assets. So say there's a claim of 100,000 and the company has 100,000 of assets, will be paid out by the company. Do shareholders who just own shares in a company don't have personal liability, but directors who manage the company potentially have liability if they do things like fraud or trading while insolvent.
Right, okay.
But generally speaking, if you have a company, either as a shareholder or a director who does the right thing, you shouldn't expect personal liability.
So it's definitely safe to say that you reduce your personal
Yes,
liability
you
quite
reduce.
considerably
You do,
if you
you
become
do.
a company.
Yeah.
Tax. Now this is a fairly obvious one, as we were talking before about entities and how you structure yourself with the ATO. Sole traders pay personal tax on their earnings, which mean they take advantage of the tax-free threshold. So I
Yes.
can't quite remember exactly what it is. I think it's about 18 grand at the
Yes,
moment. So the first
yes.
X amount of dollars you earn are tax-free. Then after that, as we all know, it goes up in increments. So, but companies pay 30 cents on every dollar, 30% tax right from the first dollar that they earn after deductions.
After deductions, yes. So
Yep.
there's actually 2 crucial things to consider. What are my deductions and what's the tax rate?
So you want to look at your taxable income, which means your income after deductions, and maybe look at it on a projection over a number of years. And if you can see yourself becoming, I know that a lot of businesses and accountants bandy about the figure of 100,000. If you're clearing 100,000, your taxable income is 100,000, then it becomes more worthwhile to become a become a company, because you reduce that potential tax debt of being 50% tax down to 30% tax.
Yes.
But
It
you've got
is
to
a
remember
rule
that
of
that
thumb.
happens from the first dollar. So if
Yes.
you've got to look at that projection, because if you've got to have a whopping great big fantastic year, but then that's because you've got this contract coming in for one company who said definitely not going to happen for more than a year, then your income's going to drop off again. Perhaps in the long run that's not worthwhile, because you do need to consider all those costs we were talking about before. The
Yes.
registration, the fees, the accounting costs, the extra admin, the fact that you've got
Yes.
to do all that extra paperwork.
Yes.
So it's you have to look at the long-term cost of running it rather than the relatively expensive way of running your business as a sole trader.
Yes, and
So-
look, for example, if it was one person working part-time, that might, for the long term, that might be quite different to someone working full-time, planning to hire, staff regularly, planning to grow the business. That's 2 quite different decisions.
That's right. But you can hire people as a sole trader.
Yes, you can.
Yeah,
Yes,
you don't
yes.
have to be a PTY Ltd in order to bring on staff.
No, if you're planning, it's more that if you're hiring people, you're probably earning more revenue. So if you're planning to grow your business, each year, strong growth plans, your revenue is probably going to be higher. So that's one reason when it becomes more tax effective to have a company rather than a sole trader.
It's also something one other thing that just popped into my head to consider as well. When you are a PTY Ltd, you do look bigger. You have that sort of air of a little bit more professionalism. I know a lot of people in the construction and building industry tend to become PTY LtDs much sooner than it is in terms of tax effectiveness because they get more work coming down from their bigger clients because they're seen to be a little bit more, I don't know, organised. They've got this air of being bigger than what they are. So often that sort of emotional step is another thing to consider as well. And I have to say, from our own personal perspective as being a sole trader company for a number of years, when we became a PTY Ltd, there was almost this burden lifted off our shoulders because we went, well, you know what? Now we don't talk of it as our business. We talk about it as the company.
Yes.
So you've actually got that emotional disassociation, which can help with, well, you know, it's just the company's problem, it's not mine, or that sort of thing's happening. So, yeah.
There's one other quite exciting difference between being a sole trader and being a company is the potential to bring other people in. So say you have a similar and complementary business to someone else and you would actually love to work together. If you have a company, you have the potential to own, say, half each and grow your business together in quite a different way than if you were two sole traders working next to each other. So that potential to bring other founders on, other shareholders on, is a particularly exciting part of having a company as well.
Well, when we get back from the break, we're going to talk about the process of moving from a sole trader to become a PTY Ltd. It's a jam-packed show today, Jade.
Awesome. This is, a lot of content that we're going to be covering. Let's go to some community service announcements. You are listening to Small Biz Matters on The Breakfast State on Triple H 100.1 FM. You are listening to The Breakfast State on Triple H 100.1 FM. It is Terrific Tuesday, which means we're doing Small Biz Matters. And Lexi, let's just jump back into it. That's
right. Before the break, we were talking about the main differences between pros and cons between when you're a sole trader becoming a PTY Ltd. So a lot of things to consider. It's not just about the tax, not just about the liability, not just about the fees, but you need to weigh up all of these things. And also you need to project your income over a number of years so that you're not just looking at a massive growth spurt which may fall off the following year. So there's a lot of things to consider. It's not a very straightforward answer. So now we're going to be looking at, looking from the transition. Your business is growing and you want to limit your personal and tax liability. There's generally two reasons why sole traders might become a company. So this is just in general to sum up what we were talking about before. They want to limit their tax they pay, so they've moved to the next tax threshold and are paying more than what they would if they were paying company tax, which is 30%. And they want to limit their liability. They want to be personally sued if something goes wrong. So we talked about that before the break. The other reasons might include being able to incentivise employees with shares and the ability to bring in investor shareholders. We did talk about bringing on investors, but Ursula, can you explain to me the process of and why it's an advantage to be able to incentivise employees with shares in your company?
Yes. In fact, the topic of giving employees shares is a really hot topic at the moment. There was just last week some new law released. So why would you want to give your employees shares? You've got two main reasons in terms of incentivising your employees and saving your company money, which you can use to grow the business other ways. So often as a small business, you don't have huge amounts of cash and you want to keep that cash to grow the business, for example, marketing or buying new equipment or investing in something else. If you want to bring on great employees, you might be able to offer them a certain salary and then a portion of that in shares. So say you want to pay them $70,000, you could give them $50,000 as a salary and $20,000 worth of shares at the end of the year. What does that mean for you? It's $20,000 more left in the company to grow the company.
That you're not paying tax on. Or do you have to pay PAYG? Or is that a question
we're
for an
looking
accountant?
from the company perspective on one hand, and so from the company perspective, correct, the salary is $50,000. Correct. From an employee perspective, there's a risk. The company might do well, the company might do not. But if you back yourself and you back the company, this is a unique opportunity to get those shares. Imagine the guys who got the early shares in Google.
They're pretty happy with their decision, yeah.
So the only way you get that $20,000 worth of shares, and the idea is that they're yours. You keep those, so you work in a business for a while, but say years down the track, as the company grows, the idea is that you can sell those shares for considerably more than you were given them for, and so you make money as well.
So I guess it gives the added incentive of people to want to work harder because they want to grow the business, because they want to see their shares improve.
And look, and it's all of those it's all the magic that each new employee brings about, the drive, the thinking about the company, the wanting to grow it, the new ideas. As a business founder, you want those people around you. You can't think of everything.
How do you avoid an employee coming on and just saying, okay, I'll take my $50,000, I'll take my $20,000 worth of shares, and 3 months down the track I'll leave? How do you avoid that?
That's a really good point. You can build in, well, first, that they have to stay for certain periods of time to get their shares. So at the end of each year, for example, and they have to still be employed, and usually they have to have met certain performance hurdles as well. Second, if you want to and you can negotiate it with the employee, you can say, if you leave, I will buy your shares back at whatever the current market rate is. So that's the way for you as a business owner to keep those shares and be able to give them to someone else.
And this is all in their employment contract that they sign at the beginning?
Correct.
Right,
yes.
okay, so that's how you would set that in stone.
Yes.
Again, all the more reasons to make sure you've got these sort of contractual things set in place from the beginning.
Yes.
And I suppose that's something you need to consider when you're bringing on staff. It's an added dimension, but maybe that's something that might work for you to start incentivising right from the beginning, particularly if that person perhaps is in sales.
Yes.
If that's their forte is to help grow the company and grow the client base, and then they've got the added incentive of seeing their shares improve as well,
Yes.
then it's good. I think it's an important point because maybe it's another way to get around that big issue that a lot of businesses have with staff retention at the moment.
Yes. Cash flow and staff retention, I think, are two crucial issues for small businesses.
Typically we have, I would argue, a generation of people coming through who believe that 2 years at a company is a really long stretch, and then they move on to something more interesting. So perhaps building into the employment contract in terms of, can you stagger how you divvy out those shares?
Yes,
First
you
you
can.
get this, second year.
It's quite common to have them split over 2, 3 or 4 years, and it's called a 1-year cliff, so you have to work for 1 year before you get anything, and then you get, say, a proportion of those each year.
So it's really good to know that you've got that flexibility within your employment contract. Can you, once somebody's signed the contract and those sort of things are all in place, are you within your rights to amend the employment contract?
Look, if you change the contract, it basically has to be by agreement between the two of you.
Okay.
If it's a material negative difference to the employee, then there's issues to consider.
But you might be tightening your, say, sexual harassment or all those sort of aspects of the business. You might be just tightening those things up, and then that's okay because that helps both people and both parties.
And for example, you would write in that you sit down each year and work out what the incentives are. For example, you expect that those will change each year as the person grows.
So when you're doing the process of moving from a sole trader to the company, you ask yourself the two key questions, which you mentioned. How do I want to run my business? So sole trader versus Pty Ltd solves your liability problem, but not your tax problem. Okay, so you want to keep the money in the business, but you don't want to remove it. So can you explain to me how just asking yourself that question of running the business impacts on the process of becoming a sole trader to a Pty Ltd?
I'll give you a simple example of someone who's earned, say, $150,000, which is quite a lot, puts them in a high tax threshold. If they had earned that money through as a sole trader, they'll be paying tax on $150,000. Now, then they might use it to buy some equipment, but they've still paid that tax up front and now they're buying equipment. If it's a company and you make $150,000, you may choose to pay yourself $50,000, so you only pay tax on $50,000 as an employee, and then spend $50,000 on the equipment. So it's quite different options in terms of using the money in the business.
And how you run your business in terms of how you use those finances. If you can project that you're going to be earning that X amount of dollars, you also not only need to do that projection, but imagine, okay, I've got that money now. Do I want a reinvestment in maybe some capital expenditure or some marketing materials? Or do I want to pay myself that fee as a company?
Yes.
Another question for asking yourself a key question when you become a company: how do I want to own my shares? Now, this is something I'm going to let you discuss because I find this a little bit confusing. I know that when we became a company in our family business, 100% of the shares went to the director, which was my husband, but we also had the option of splitting the shares 50-50 as a partnership between he and I. So that, I am assuming, would split the tax burden for the dividends that came back out of the company, because that would be considered income for each of us.
That's correct. So I'll go through 2 examples just to illustrate 2 different ways it could be. So big picture, if you own a company, you can be paid a salary as an employee, or you can be paid dividends as a shareholder. What does that mean? For example, if you own Commonwealth Bank shares, NAB shares, you get the occasional cheque, that's your dividends, exactly the same as if it's a private company. So alternative one, the company is owned by a husband and wife, 50% each. If there's 100,000 dividends, you must pay it 50% each. So 50,000, 50,000. There's no discretion. You have to pay it in the same proportion as the shareholdings. But what if that woman is also works full-time in another job and has a high salary, whereas the man doesn't have another job and has a much lower salary? You don't want to give them $50,000 each. You'd rather give the man 100 and the woman nothing because she has a separate salary.
That's right. Otherwise, she's got to be pushed into potentially a higher tax threshold and start paying even more tax.
So it's not just for separate companies. So it's all your total income that gets taxed.
Yeah, exactly. Not just the dividends that you're earning from that personal company, but also from your wages.
Whereas if the company shares are held in a discretionary trust with, say, Alexi and her husband as the beneficiaries, each year they have discretion to choose. So of that 100,000, one year Alexi might get all of it and her husband nothing. Another year it might be 50-50. Another year it might be 70-30. So the business is in a company, you own your shares in a discretionary trust, and each year you have discretion as to how much each of you gets.
So does that mean that you've basically got the entity, which is the company, the PTY Ltd. Correct. You have each of your personal entities. So you've got myself and my husband being just people who may be earning wages and are earning dividends. Does the trust then become another entity?
We'll keep being an employee separate. So two alternatives. Business is through a company, but you own the shares personally. Or business is through a company, but the shares are owned through a trust.
Does that trust become a different entity again?
Basically, yes, via a trustee.
Okay.
It gets to the stage where it would be better to have a diagram, and I wish I could share a whiteboard with everyone. Yes. But basically, you can own, the company owns the business, or the company is the business. You can own your shares personally, Mr. Smith, Mrs. Smith, or the shares can be held by the Smith Family Trust, and then you can decide who are the beneficiaries and how much money each of them gets through a discretionary trust.
And I think that's an interesting point, is because you could have family members being beneficiaries of that trust income.
Yes.
Including children and including people who don't pay tax?
Including people who, including all of those. There's tax issues with what you give children.
Yeah.
But the key issue to remember is, if you own your shares personally, it's fixed what share of the dividends you must get. If it's through a discretionary trust, each year you've got discretion.
Okay, excellent. So let's just take a break to absorb all of that. I think there's a lot of things to think about.
Again, there's a lot of content that we've all got to just take in and everything like that. So let's go to a bit of Pink Feel Good Time. You're listening to Small Biz Matters on The Breakfast State on Triple H 100.1 FM. That was a bit of Pink Feel Good Time. You are listening to The Breakfast State on Triple H 100.1 FM, and we're doing all things Small Biz Matters this morning with Lexi and our very special guest, Ursula. And we're talking about what's the difference between a sole trader and a company, and what benefits and whatever else. So, Lexi, let's jump straight back into it, because I know we've still got quite a bit to cover.
That's right. So we'll just talk a little bit about what the actual process is from moving from a sole trader to a PTY Ltd. Now, the best person to do this through is probably your accountant. Or your lawyer, just to make sure that you've got all the legal processes, or both actually, if you really want to do it properly. And so what you do is your entity, and it's best to do this at the end of a financial year. Certainly at the end of the quarter. Don't even attempt to do it in the middle of a quarter. But end of a financial year, it's a really clean break from your previous accounts. Now remember, of course, if you've got your accounts on MYOB or Xero or whatever, you actually create a whole new company file as this new entity. So it's really draw a line in the sand, and then you become, or the company comes into fruition. You have your setup costs where you're registered with ASIC, and all of your registration costs, which are generally covered through your accountant. And then you also have the process of setting up a new ABN. You have to register that new business for, if you've got employees, for PAYG, and also for GST. So remember that you are now conducting your BAS as this separate company entity. You may still have to complete BASs as a sole trader for a little while, I found that I've had a couple of companies approach me and say, look, I've been told by my accountant to continue filling out zero BASs. Not sure whether or not that because it was a lag in the system or they were just told to do that until. So just that may happen, but it's a fairly straightforward process. But remember that from now on, you draw a line in the sand and all of your income and everything goes through the company name. So you've got a new ABN, you've then got a company number, an ACN.
Yes.
You're registered with ASIC.
So you'll have a new ABN. You may have had an ABN personally.
Yes.
The company has its own ABN. Company
Completely
has its
separate.
Own ACN, of course.
Yep.
Company has its own tax file number.
Exactly. Oh, yes, a tax file number as well. So you actually get a whole lot of documentation from the ATO when you're setting up this new entity. And of course, you need to make sure that you're set up to be GST registered because they're not going to assume that you're going to be GST registered because it's a whole new company.
Yes.
And also PAYG registered as well. So there's all those setup costs, and then from then on, you then this is what I find a little bit odd. If particularly you have a single director who has 100% of the shares, you have a meeting with yourself once a year, and then you sign the minutes,
Yes.
and then you send them back to your accountant. And it's in this instance you can maintain the paperwork yourself, but apparently there's quite a specific way that you have to maintain that paperwork in. I want to say folders or something, but you pay your accountant to look after that paperwork for you, or you can try and do it yourself. I think this is where my confusion lies.
The absolute key thing to remember is a company's a different entity. So you've got your own Australian company number, ACN, you get a new ABN, you get a new tax file number, you keep different records. The company is different from you.
And your accounts are different.
Your accounts are different,
And also all of your collateral, your printed collateral, your business cards, your tax invoices, remember to change those all over to the new ABN. They must have, if you were a sole trader trading under a registered company name that didn't have Pty Ltd on them now, all of your business name needs to have Pty Ltd on it now if you've changed from one thing to the other.
Yes, your letterhead, your invoices all have to have your company details on them, yes. Now, if as a sole trader you had a business name, then you can move that business name across to be owned by the company, so the company can use that.
You're just adding the Pty Ltd onto the back end of that and making so the printed collateral is actually an important point. You may have to have your business cards made up.
Yes.
So that's an important. That pretty much covers the process, and it is a once-off process.
Steps, yes.
You don't have to go through this every year. And then remember, of course, that when it comes to tax time, you will be dealing with your own personal tax, and then also dealing with the company stuff, which will be a completely separate entity as far as the ATO is concerned.
Yes.
So that's that in a way. And remember that, of course, once you get to a certain income threshold, the company is going to be expected to pay quarterly instalments of its own company tax. So this is where I think some business owners get a bit confused with their BAS. You have your GST difference that you need to pay. Then you've got your PAYG withholding from your employees. Then you've got your pay-as-you-go company tax. So you may start to need to pay, the tax department decides, okay, well, your company earned $100,000 last year. We're going to start taking a little bit of that money each quarter so that you're reducing your tax liability at the end of the year. Or if you're really lucky and if you've made your income down to zero because of deductions and capital spend, you might get all that money back. So it's almost forced saving. The ATO wants to know that you're giving it money incrementally rather than a whole big lump sum at the end of the year. So that's another factor to think about as well. So we've talked about the actual structure itself, the movement, the process of moving from a sole trader to a company, all the things you need to consider when you actually make that transition. So what are some of the complications that might arise? And there's a myriad, I'm sure. But what are some of the advantages and disadvantages that we can talk about?
Well, I think one of the exciting things about being a company is you now have shares that you can give to people. So we talked about giving small amounts, the company issuing small amounts of shares to employees as an incentive, and that's great. And there's new legislation around those employee share schemes, which currently employees pay the tax up front, even if it's just an option to buy a share, whereas we hope the new legislation will come in which says that the tax is generally going to be payable when those shares are sold, which is very important.
Okay, yeah,
because
that's a big difference for
Correct,
people, because that will remove the incentive of it'll improve the incentive of giving it to the employees.
Yes. Currently, small businesses haven't been issuing shares to employees, because if I issue you shares and they might be worth around 20,000, you have to pay tax on them.
Yeah.
When I didn't actually.
They might be valueless until we actually start.
Until you actually sell. That's
until
the
the business actually starts growing.
Correct. And so the much fairer position is what we hope will come in soon, is that the tax is payable when those shares are sold, when you get money for them.
So that's the difference between employee shares and just going and investing in the share market. You don't pay tax on things until they're realised, and dividends come in with the share market. If you buy
shares on the stock exchange, you don't pay tax for buying shares. It's only when you sell them on the difference.
Yes.
Yeah.
Yes.
So here, when you're giving employees shares, the change in law is that, subject to various rules about it being a small company, etc., they'll only pay tax when they actually sell those shares and make money.
That's good.
Yes, that's very good. It makes it a genuine incentive for employees to get shares.
Do we have a time frame on that legislation, just out of curiosity?
So the draft legislation came out last week, and we're hoping that it will be clear and in place by the end of June, so people can start with their new employee share plans from 1 July. Now, before 2009, employee share plans were really popular when the law was different. Then the law changed. They really went quiet. We're hoping they'll come on again, because there's huge amounts of buzz in America around some of the companies that have done so well, the Googles, the Facebooks, etc. And it'll be really exciting to be able to bring that kind of buzz to Australia.
I think it really would improve with staff retention and people actually, that care factor when you've got a job, and loyalty.
Yes,
which would be nice.
Now, completely separately from your employees are the founders, the people who are the foundation of the business. Now, say you and someone else set up a business together. You're going to own a chunk of shares each. Two people are working equally. They tend to own, say, 50% each until you start issuing more shares. So the goal here is, this is fantastic. You're building something together. You're both equally incentivised to work really hard. There's a crucial legal document that we recommend people put in place called a shareholders agreement. And that documents all these expectations and hopes and dreams into a legal document, and it particularly protects you if and when there's a dispute and things start to go wrong. So why would you have a shareholders agreement? What would it cover? And this is, as I said, particularly between the founders of the business, people that come in together to make this work.
And this is all about what we were talking about right at the beginning of the show, set things up properly to begin with.
Yes, and look, it's really common. We get two people in starting a business together, which is great. Except if there's only two of you, how do you make decisions? So the very first thing I recommend goes into the shareholders agreement is an idea of your roles and your time and your focus. Not so much detail that it ties you up, but just big picture details. Particularly, is this full-time role for you, part-time role for you? One of the biggest disputes we see is people spending different amounts of time. We don't mind what you arrange, just understand it and make it work for the two of you. Another is who's bringing money, who's bringing skills, or both.
Or somebody might have the business sort of kind of been running to set up with, but they want to bring on this other person.
Yes.
And it's going to be an equal partnership in a way, but by the same token, this person has been investing in this business and put all this money in to begin with, and this person just bringing on.
The first founder might have the website, the branding, have worked away for some time without any income, etc. So they're going to want to have a higher percentage of shares than the person they're bringing in. So how many shares do you have? That's a negotiation for the people at the time.
In terms of negotiation, it's a really good point. I wouldn't, in a pink fit, want to sit down with someone that I'm about to set up a business with and try and do this between ourselves.
Yes.
That's nuts. Bringing in a third party helps to unemotionalise the issue.
Yes.
It means that you can talk about it in terms of a legal structure, in terms of...
Yes.
And get it nutted out right from the beginning.
Yes.
And I'm sure that you coming in with a company like Legal Vision and supporting people through this process, it becomes a discussion. It's not just, you tell us what you want us to do and we'll just put it into a document.
No, we sit down, literally around the table, we go through specific things, everyone knows what we're going to talk about beforehand, and we explain why this stuff matters and how important it is to work it out and then move on.
And you'll know the questions to ask.
Yes,
I mean,
we do.
you know,
We do,
I
yes.
know next to zilch when it comes to legal stuff,
Yes.
but if you
Yes.
don't know anything about it, then get someone to support you.
Yes.
Outsource
And
this
look-
particular importance.
It is a difficult conversation because you have to go through things like what happens when one of you wants to leave, and everyone looks a bit uncomfortable, says no one's leaving. I say, look, guys,
Realism.
you're not going to work together in this company full time till you're 80, so let's work backwards from that. And then everyone kind of relaxes because it's not about loyalty, it's just about planning.
And no one's brought it up yet because they're both
Exactly.
thinking it, but they don't want to
Exactly.
actually talk about
Yeah,
it.
And if they're feeling awkward about me talking about losing shares, I then get to move right on into what happens if someone dies. So
Which is not a fun chat. Yeah.
no. But people are not going to want to talk about these things, and quite frankly, they're not even going to think of talking about these things, but it's crucial. Like, say, you know, you and your friend Louisa are working really hard and one of you becomes incapacitated. Well, if someone passes away, the shares go to that person's, probably their spouse. Now, I bet Louisa's husband can't think of anything worse than working full-time in your business, and you can't think of anything worse than trying to work with him. No one would want that.
So you really consider all the options and all the scenarios,
Yes. You build
which
things
you won't
in,
be able to think about because you're
No.
so busy working in your business instead of on
Exactly.
it.
You build things in like if someone passes away, the other person buys their shares. All kinds of things are considered and written up, including how to resolve disputes, which is crucial.
There's also something to consider as well when people are coming together as a partnership. Sometimes it may just be a brand new idea, a brand new business, and they're just coming together from scratch. But quite often it's someone stepping in and bringing something that can be considered 50-50 into the relationship. But I think a very important part of this process is valuing the company for what it's worth
Yes.
to begin with.
Yes.
And I think a lot of small business owners going, well, without me, this company is nothing. No, in actual fact, this company has value. If you went to go and get a business loan, the bank is going to be looking at your company in terms of what it's worth because they
Yes.
see it. So you should be considering it and thinking of your company in the same way.
Yes, you can look at your business assets. You can look particularly at your contracts. Like, say you're a servicing company, like a cleaning company, and you have 1 year, 2 year, 3 year, 5 year contracts with customers. That's worth a lot. That adds value to your business.
That's right.
Yes.
And this is another thing that can be packaged up when you're thinking about things like shareholders agreements and setting up the company structure to begin with, and how this all works. It's such an important conversation, I think, not just if you're considering bringing someone else on as a partner in terms of why you need to engage with a legal company, but also it's very important even just for the transition between a sole trader and a company, because you need to consider and think of yourself as no longer being the company.
Yes.
It is now
Yes.
a different entity, and legally it is treated differently. So you need to really understand the legals, not just the paperwork, not just the admin, but actually the legal ramifications for that as well. And talking about bigger things, we did touch on this a little bit earlier in terms of trusts, but you need to know all the best options for you and your family, even if it's just that easy transition between sole trader and company, and know what the best options are for you. And you're not going to be able to do that, without engaging with someone like yourself to really get it straight.
Yes. And look, we find many businesses come to us when they're just setting up as a company. We incorporate their company for them. We do their shareholders
And that's
agreement.
the best time to do it.
Absolutely, yes. Look, you don't need to spend thousands of dollars regularly with a lawyer. The idea is that you incorporate the company, you get your shareholders agreement, and then you just go and run your business. You may not need to use a lawyer again for years, and that's fantastic.
I would suggest, however, that when you start bringing on employees and you
Yes.
start talking about share agreements as part of their employment
Yes.
agreements, or even just having a proper employment agreement in
Yes.
place, that you would then engage
Yes.
with a legal firm again,
Yes.
just to make sure that that's all proper.
Yes.
Because the worst thing and the most fearful thing I know, talking to businesses and what I do, is they're very concerned about bringing people on because they think they're going to get taken for unfair dismissal.
Yes.
And
Yes,
remember, as a
yes.
sole trader, you are liable for any costs that are associated with an unfair dismissal.
Any legal costs you're
Right.
potentially liable for, yes.
Exactly.
Look, if we see many of our clients we see when they're setting things up, other clients we see when things go wrong. It's worth pausing each new step. Okay, I'm going to bring on employees. I'll just get one really good employment agreement that I can keep using.
Or contractors as well.
Correct. Then if you're going to bring on contractors, get that set up properly, so you don't, for example, get bitten by unexpected tax or superannuation liability. The same with dealing with your clients. Just get one really good master client agreement that you keep using, because the cost of getting one client agreement is often just the same as the cost of the money you get from one client. So if one client refuses to pay, you would have been better off having that client agreement in the first place, so that they were required to pay.
That's
Yeah.
right.
Yes, it's just a small business only needs a few crucial contracts that they can keep reusing, but it does make a big difference for peace of mind and for protection.
And I think people don't need to be considering this as being, something that's going to cost their business in the realm of tens of thousands of dollars.
No.
It's really just, I mean, I don't want to put ballpark figures on or anything, but it's not that. And it's something that you need to, if you are thinking about the transition and you're thinking, right, my income's beginning to get to this threshold, my liability I want to reduce, all these sort of factors, you need to include in that cost some setup costs in terms of legals.
Look, I'm actually happy to give a bit of an idea of cost because it's such an unknown for people. And one of our goals at Legal Vision is to have fixed fees. So I'm just...
And let me just pause there and just say that Legal Vision is the best legal website I've ever seen. It is so easy to navigate and it's so easy to find what you need and to get hold of someone really quickly. It's just not gobbledygook.
Thank you. Look, we wanted to build the kind of law firm that we would want to use if we were a small business. And we, the three of us founders started it together. It's been going a couple of years. We've been through what it's like to be a small business. We absolutely understand cash flow issues, how to use your budget. Yes, we get where our
it's
clients
certainly
are
more
coming from.
accessible than anything else I can imagine in that sort
Thank you. But look, because people are so, the costs are unknown. So, for example, you can get a good solid employment agreement that you can keep using, depending on how difficult it is, for around $1,000. You can get a straightforward shareholders agreement between you and other shareholders from $1,500. You can get a client agreement between you and all your clients that sets out all the kind of particular issues and risks that you face and have to consider, for around $1,500.
And remember, all of these things are tax deductible, of course.
Correct.
So it's,
Correct.
if you're a company, then you can knock 30% off that.
Yes. And I'm not saying that these are small costs like $100, but it's not the tens of thousands that people think about. We regularly set people up with a whole suite of contracts for a few thousand, which is quite different to tens of thousands.
And it's not as though this legislation is going to go through any massive overhaul that these contracts then become null and void because they're not usable anymore. That's obviously factored into it, as well as that they can be used again and again over years and years.
For example,
that
contract
flexibility
between you and your client is largely based on consumer law. Consumer law is pretty steady law. Yes.
So yeah, there's lots of things to consider today. We've gone through a myriad of things to consider for small business. But just like to remind everybody that the podcast will be available on the Boyd Office Management Services website. You can also go to the, we usually put updates when the podcasts hit the website via the Boyd Office Management Services Facebook page, but also what we'll do at this time is we'll put a notice on the breakfast date just to let people know when it's up there, because this is going to be a hugely popular podcast that people, and please feel free to share them with your other small business networking people. I think it's something that's applicable to every small business, not just if you're starting out as a sole trader and you've just got a little boutique business. You need to consider these things down the track and plan for the future and plan legally and in terms of entities and all these scenarios, plan for the future. But make sure, and we talk about this almost every week on Small Biz Matters, make sure that you're setting yourself up correctly.
Yes.
This is great for litigation avoidance. This is great for making sure that you get your money out of your clients.
Yes.
That you avoid being sued by employees who are disgruntled.
Yes.
Get it in place first, because the amount of money that it can save you down the track is huge.
Yes. Time and money saved. Yes, that's the goal. Now, we have a good infographic which goes through the different ways you can do your business, sole trader, company or trust, which I'll give you as well, because not only is it informative, but it almost looks a bit fun. So you almost want to read it.
Fantastic. Well, we'll pop that up on the Breakfast Date Facebook page. But just a really big thank you for taking the time to talk to me and all of my listeners today, Ursula. So thanks for coming on the show.
No, absolute pleasure. Thank you very much for having me, and thank you for listening.
And there you go. That has been Small Biz Matters for this Tuesday. Thank you, Lexi, as always.
I'll see you next week.
Show. And thank you, Miss Ursula Hogman from Legal Vision. Check out our Legal Vision website. What was it? The best website you've ever seen? Oh, legal. Oh, sorry.
We should probably tell people if they'd like to have a look. It's legalvision.com.au.
Okay.
All one word.
That's correct. And if you want to phone, we're on 1300 544 755, and we do free initial assessments over the phone for peace of mind.
Gold dust.
Awesome. There you go. Does not sound any better than that. I'll tell you what, this has been a jam-packed Sport Biz Matters. We got to go some community service announcements, and then I'll be wrapping up the breakfast date. But thank you, ladies, for that great chat.
Thanks for having us.